What's going on, guys? Alex here, and today I'm taking a break from trick-or-treating on Halloween to talk about something truly scary, and that's taxes. And specifically, I'm going to be taking a look at the Joe Biden tax plan and seeing what implications it can have on the average American and what the specific plan points are that he's looking to put in place should he be elected. So, with that, let's take a look. Now, first, I went to the Joe Biden website, and I expected to see a list of proposals that would include the tax changes and a bunch of specifics with regard to what was going to be implemented. So I started looking around here. I found a page with a bunch of plans, and I searched for the word tax. I only got this tale of two tax policies thing here out of all these different plans. So in taking a look at this page, there's a lot of fluffy information with regard to what the policy is going to do and what the results are going to be, what effects it's going to have on a macro level. But what I wanted to know were the bullet point items of what the plan is going to do and what it's all going to mean when it's put in place and if it's put in place. So scrolling down here, you do get some specifics and it talks about the corporate tax rate, true minimum tax on all foreign earnings of U.S. companies, and so forth. So a few bullet points here, but not a lot of juice. And I wanted to get into the fine details and really pick this thing apart, see what the upsides are, what the downsides are, and understand it a bit more. I did find a more detailed analysis on the Tax Foundation website, which I understand to be nonpartisan. This is not supposed to be a political discussion. It's just meant to analyze the proposed tax plan. And with that, this offers a bit more insight as to what is being proposed and what effects it may have. So let's go through the list and see what we have. This is the details of the Biden tax plan. And a lot of these initial points are going to touch on the individual side of things. So not so much the business side, but the individual side and what effects it's going to have there. So let's start right at the top. The Biden tax plan imposes a 12.4% old age survivors and disability insurance, so essentially Social Security, payroll tax on income earned above $400,000, evenly split between employers and employees. This would create a donut hole in the current Social Security payroll tax, where wages between $137,700, the current wage cap, and $400,000 will not be taxed. Let me explain what that means. When you work as an employee for an employer and you receive a W-2, essentially there are Social Security taxes and Medicare taxes being paid on your wages. Now, you as the employee pay half of the Social Security tax, which your half is going to be 6.2%. The total Social Security tax is 12.4%, as was outlined here. So half of this is paid by your employer and half is paid by you as the employee. So when you look at your W-2, you'll see that Social Security tax withheld. That's going to be that 6.2%. On top of that, you also have Medicare tax, which is 2.9%, and it's also split 50% between the employer and you as the employee. So you'll see that Medicare tax being calculated as 1.45% of the wages. There are some nuances in terms of what's included in each category and what isn't, so you may not have those exact numbers come out on your W-2, but that's the general idea. Now, the Social Security tax is currently capped. And what that means is it's only applicable on the first $137,700. That's the current wage cap. And the wages earned above that amount are not subject to Social Security. The way you'll see this play out on your W-2 is that you'll see wages in box 1. Let me just show you here. Looking at the form W-2, you'll have in box 1 wages, tips, and compensation. So this number is the amount that's going to be taxed for income tax purposes on your tax return. Aside from that, you also have Social Security wages, and here, if you have wages higher than the wage cap of $137,700, this amount, then that is the amount you will see in this box right here. So the wage cap is going to be applicable there. So you may see $500,000 in wages, tips, and other compensation in box 1. But the Social Security wages is going to be capped at this $137,700 amount. So the highest amount of Social Security tax that you should pay as an employee, and this is assuming with one employer. I don't want to make it too complex, but let's just take a look here. So 137,700 times 6.2%. That's the maximum amount you should see in the W-2 right here in box 4 in a particular year. And even if you have multiple employers in a year, they may each withhold that full amount, but you'll get a refund for the excess that you paid over this amount when you file your return. So even if you have multiple employers, this cap is still going to be applicable, and you're not going to be charged Social Security taxes above this amount of wages. So what the Biden tax plan is proposing is that before there was this wage cap, so 137,700 above that amount, the wages would not be subject to Social Security taxes. They'd still be subject to Medicare taxes, not Social Security. So as you go from 137,700 and you go past 200, 300, if you hit 400,000, that in between the 137,700 and 400,000, nothing's really changing there. But as soon as you hit above 400,000 in wages, now that 12.4% Social Security tax kicks in again, and there's no upper cap to it. That's why you have that donut hole, so to speak, because you have a portion of wages that are subject to Social Security taxes up to 137,700. Then you have a portion that is not up to 400,000. So from 137,700 to 400,000, no Social Security tax. And then on top of that, you have essentially above 400,000 being taxed. So the donut hole is kind of the tax, and then no tax over here. That's why you have the sort of donut hole. You could picture it that way. But overall, this is a pretty significant tax increase, both on the employee side and the employer side. And there's a few different ways to view this, right? You might say, hey, yes, it may be a tax increase, but these people are making over $400,000. Depending on your viewpoint, of course, this is relatively subjective, but I did want to point out a sample tax return that I put together for 2019, let's say. It would still be applicable for 2020. And the only thing I put on this return is this is a single individual, filing single, and you have $1 million in wages. Now, what do you think the tax rate is on $1 million in wages? And now we want to consider both the effective tax rate and the marginal tax rate, right? Because the effective tax rate is really the average that you're paying on every dollar that you earn in taxes. Okay, so that's the effective tax rate. The marginal tax rate is the bracket that you're in, and that determines the amount at which every additional dollar you earn is taxed. So what do you think on $1 million in wages the marginal and effective tax rates would be? Think about it. Let's take a look. So in looking at this return here, we see that the marginal rate is 37% at the federal level. We're just looking at federal for now. The effective tax rate is 34.2%, so not much lower. And what this is showing is that with $1 million in wages, in this example, you are looking at a tax of $330,000. All right, so not exactly a low amount of tax, I don't think anybody would argue, all right, because essentially out of every dollar, 33 cents is going straight to the federal government, and we still have not considered state taxes, which could be another 10, 13% in California. 13% is the highest marginal rate in California. Plus, in California, you have the mental health tax of 1% on incomes over $1 million. So all this starts to add up. And at some point, we also have to understand that these are wages that people are earning. Yes, they may be earning a lot, but this isn't investment income. These aren't dividends. This isn't interest. These are wages. And of course, there may be some executive compensation, some restricted stock unit activity, things like that that's triggering a high wage amount. But at the end of the day, I think my personal opinion is these rates are already very high. And to add another, let's say, tens of thousands of dollars in taxes to this amount, I think is a bit excessive, if you ask me. And let's just figure from the 400,000 to the million, right? So we have the $1 million, and then we have the 400,000. So $600,000 is going to be subject to that additional tax at the employer and employee level. So the employee portion is 6.2%. So let's see. $37,200. So above the amount that's already being paid by this person prior to this tax ban being put in place, we're adding another $37,200 in taxes, specifically Social Security taxes. Pretty painful, if you ask me. And on the employee side, it hurts because I already have my employee clients that make high wage amounts, especially if they live in California or New York, and they're being taken out to the cleaners because not only are they not allowed to deduct the full amount of their state income taxes anymore because those are limited on Schedule A, they're not allowed to deduct the full amount of their property taxes because, again, the property taxes and the income taxes fall into the same bucket on Schedule A. They're limited to $10,000 a year. And they're hurting because they are paying exorbitant amounts of taxes at the moment, and there's very little that we can do as tax professionals to help them in some of these cases because just the amount of levers that we have with the tax code is currently limited for wage earners. And to add to that, this additional amount, I think, is getting really high up there in terms of taxes, and people are going to start to reorganize how they earn money because otherwise giving half to the government is just not attractive. I think everybody can agree there. On the other hand, on the employer side, this is going to dramatically increase the cost of hiring employees. Yes, they must earn a high amount, but still, this additional $37,200 is also going to be paid by the employer for their portion, and that has to trickle down because they're going to pass that cost onto us as the consumers, right? So with that, are we really increasing costs for everyone and that these additional increases in Social Security taxes are going to be reflected in the prices that we pay as consumers when all said and done? I don't know. That is a question for an economist. I am a simple, humble tax person, so take it as you will. That is the increase in the Social Security taxes, and that's why we have that donut hole, is because there's taxes, no taxes, and then taxes again. That's what they're referring to. The second proposal is to revert the top individual income tax rate for taxable incomes above $400,000 from 37% under the current law to 39.6%. So they're pretty much taking it back to the rate that it was prior to the Tax Cuts and Jobs Act that was essentially effective in 2018. So looking back at this tax return here, we could see that this marginal rate is at 37%. So in addition to that increased Social Security tax, then there's yet an additional hit on the marginal tax rate, which would yet further increase the amount of tax that this individual in our example is paying. It's getting up there. It's getting up there. Furthermore, the third proposal is to tax long-term capital gains rate and qualified dividends at the ordinary income tax rate of 39.6% on income above $1 million and eliminate the step-up in basis for capital gain taxation. This is applicable for incomes over $1 million. So a lot of people watching this may say, hey, I have no sympathy for those fat cats making $1 million a year, okay? They're making enough. They deserve to pay more. You can have an opinion either way on that. But it is fairly painful to take into account if you have an individual making a high amount of wages, so now they're subject to a higher tax rate. They're paying more Social Security taxes. Now their long-term capital gains rates and dividends are being taxed at ordinary income tax levels. Now, when Joe Biden says that he will raise taxes on individuals making over certain amounts, that this is only going to apply to quote-unquote rich people, yeah, it is hitting people with significant incomes very hard. Very hard. Maybe too much so, because you have to understand, when you push people too far, you increase their taxes past a certain amount, they start to re-engineer how they make their income to try to take their tax rate to a more reasonable level. And just looking at this, I mean, if you have long-term capital gains rate and qualified dividends that is going to kick in at this high rate, that may in and of itself trigger a market sell-off, right? Because if this is effective as of January 1st, 2021, there are going to be plenty of people who want to sell their securities to try to realize the current long-term capital gains rates if they can. Anybody who's doing any sort of tax planning will see this coming and try to get out of the way of this exorbitant tax rate that applied to long-term capital gains. So maybe this could trigger some significant market activity, maybe a sell-off. I'm not sure. But if you can pay 20% as the long-term capital gains rate now versus 39.6% a year from now, what are you going to choose? A lot of people are going to sell a good amount of securities, which is going to have, I would imagine, a downward force on the current stock prices. Not sure that that's the best possible thing that can be done right here at the moment with the economy in such a fragile state. But that's only my estimate of what can happen. It may very well be that individuals will say, hey, we're going to hold on to our securities for even longer. We're going to wait for these high tax rates to possibly go away, weather the storm, hold on to our securities. That may be very well how this plays out instead of a dramatic sell-off. But a few different alternatives to consider. This is interesting sometimes to think about because taxes are a method of social engineering when all said and done. So with that, you have to kind of sit back and imagine how it all can play out. And it's interesting how all this can come together when you factor in the behavioral human aspects of all of this and meld it into the tax side of things. That or maybe I'm just a huge nerd. It could be either one or both. So the big one here, though, is the elimination of the step-up in basis. Now, this is interesting because surely wealthy people and people with high incomes, they do benefit from the step-up in basis. But similarly, people with barely 2 nickels to rub together can also substantially benefit from the step-up in basis. What are we talking about? The step-up in basis is essentially what happens when an individual passes away and they have assets in their name. So let's say Ralph, taxpayer, passes away and he had a house in his name worth $1 million on the date that he passed away. This taxpayer, let's say, paid $100,000 for this property 30 years ago, and one of his sons is due to inherit the property. The step-up in basis is going to say, hey, you paid $100,000, so your basis at the date of death was $100,000. You died. Your basis is then stepped up to the fair market value at the date of death. It can also be stepped down. Keep that in mind. But usually it's a step up when you're talking about real estate assets especially. Now, the son inherits that property, and the son then has that basis of $1 million, not the $100,000. So essentially, for that $900,000 between the $100,000 and the $1 million, nobody ever pays taxes on that. Now, if the son were to go ahead and sell the property the day after he inherited it from his dad for $1 million, because that's the fair market value, there would essentially be no capital gains recognition on the subsequent sale of that property because of that stepped up basis. Usually there's actually a loss because if the fair market value date of death is $1 million, you sell it for the $1 million, there's usually some selling costs that'll actually trigger a capital loss. And that $900,000 difference between the basis before the date of death and the fair market value at the date of death, nobody ever is taxed on. That's the whole idea with the step up in basis. You can take advantage of the step up in basis if your income is negative $300,000, 0, or $10 million. It's applicable across the board for everyone. And I've seen people that are in poverty take advantage of the step up in basis. People are middle class take advantage of it, and also extremely wealthy individuals. This provision would eliminate that huge benefit. So let's take a look at the same scenario I outlined from the perspective of this plan being put in place. Ralph, taxpayer, paid $100,000 for the property 30 years ago. That's his basis. He passes away. There's no step up. Fair market value is $1 million. Now the son inherits the property. His basis is now not that $1 million. Instead, it's still that $100,000. So there was no step up. Now the son goes to sell the property. Property is $1 million. Now if it sells for $1 million, the son is going to be subject to long-term capital gain recognition on $900,000. So you could see the difference between having a step up in basis and not. And what can happen in a situation where there's no step up in basis is individuals are going to hold on to assets much longer because they want to avoid the tax hit of getting rid of it, right? So someone can inherit 20 properties, and instead of selling 10 of them and holding on to 10, they may be incentivized to just hold on to all of the properties because they don't want to pay the taxes on the sale. So this is a big one, and it's kind of surprising that it eliminates step up in basis, it looks like, for everyone across the board instead of just wealthy individuals or those with high incomes. I can be wrong on that, but that's my impression just having read this. And again, the Biden website doesn't really have all that much detail on this. Let me just do a search real quick. Okay, so just to be fair, there's no basis. What about step up? Okay, so there's nothing showing up. All right, let's continue. And there's also a cap on the tax benefit of itemized deductions, being 28% of value for those earning more than $400,000, which means that taxpayers earning above that income threshold with tax rates higher than 28% would face limited itemized deductions. Now, this is further hitting the benefit of Schedule A and decreasing the amount by which individuals with higher incomes can reduce their overall tax liability. The Tax Cuts and Jobs Act did this to a pretty significant extent by limiting state and local taxes to just $10,000 as a deduction on Schedule A. It looks like this is going to go even further in limiting the applicability of those itemized deductions for individuals subject to higher tax rates. So even if you're subject to that 39.6% rate that the Biden tax plan is proposing, your itemized deductions will only allow for a reduction of 28% per dollar instead of 39.6% of your taxable income. So again, this is a way to get at the higher earners and have them pay more in taxes. In the same vein, the tax plan also restores the P's limitation on itemized deductions for taxable incomes above $400,000. The P's limitations were essentially limitations imposed on those itemized deductions, yet again, if your income hit certain thresholds. And this was applicable prior to the Tax Cuts and Jobs Act, which did away with the P's limitation, but it also limited itemized deductions in certain ways, like that $10,000 limitation for state and local taxes. What the tax plan is doing here is, again, hitting at those higher earners by making sure that their itemized deductions don't significantly decrease their total tax that they pay. Furthermore, the Biden tax plan phases out the qualified business income deduction, also known as Section 199 Cap A, also known as the QBI deduction, for filers with taxable income above $400,000. Again, that $400,000 seems to be a sticking point. And with the QBI deduction, it is possible, even if your income exceeds that amount, the way things currently are structured, to obtain a tax benefit. For the QBI deduction, it is essentially a deduction of up to 20% of your taxable income or your business income, whichever is lower. And it's pretty significant. It was put in place by the Tax Cuts and Jobs Act. And there are certain phase-outs that are applicable depending on the industry that you're working in, the type of business, the income amounts. There are a lot of different factors that play in. It's quite a complex deduction, actually. And essentially, what they're doing is completely eliminating it for taxpayers with taxable income above $400,000. Again, they're really hitting on this $400,000 mark. And one way to think of it is, well, $400,000 is a lot of money. But when you consider that two wage earners making $200,000 each, they're already hitting that mark. All right? That's not really all that much money when you consider the, especially taxpayers on both coasts, being in California and New York. At that point, you'll see that even with $400,000 for a family, it doesn't really go all that far. So when you're considering that this tax plan is supposed to hit higher earners, I have questions about that 400,000 threshold personally. All right, so furthermore, the tax plan expands the earned income tax credit for childless workers age 65 plus, provides renewable energy-related tax credits to individuals. So the earned income tax credit is a credit that's applicable to individuals that work but don't make all that much money. There are income limitations applicable to the EITC, or the Earned Income Tax Credit. So in this case, there's some benefits being provided there. Furthermore, expands the child independent care tax credit from a maximum of $3,000 in qualifying expenses to $8,000 or $16,000 for multiple dependents, and increases the maximum reimbursement rate from 35% to 50%. This one's kind of self-explanatory. Child independent care credit are amounts that you pay for the care of your children, which then allows you as the taxpayer to work. A few nuances there, but in terms of the tax benefit, certainly increased through the Biden tax plan. There's some other information here regarding the child tax credit, so you can read that if that's applicable for you. The plan reestablishes the first-time home buyers tax credit and expands the estate and gift tax by restoring the rate and exemptions to 2009 levels. And essentially, what that means is the amount that you can either gift or have in your estate that's exempt from estate tax, more or less, that's what we're talking about here, is going to be lower, quite a bit lower. So those individuals with taxable estates would take notice of this, because that can mean that a larger portion of their estate can be subject to the estate tax when and if they pass away. Well, usually when. Aside from the personal side of things, there are also some corporate business changes that are being proposed. So the Biden tax plan increases the corporate income tax rate from 21% to 28%. Quite a significant increase. And on one hand, the big complaint about corporations is that they pay zero in taxes. And one way to think of this is if they're paying zero in taxes with a 21% rate, they can very well pay zero in taxes with a 28% rate, right? Because 21% or 28% of zero is zero. On the other hand, this can have an implication, because if a corporation is actually calculating an amount of tax and then using, let's say, net operating loss carry forwards or credits of certain kinds to take their tax liability down, this can have an effect in that those companies may pay some or a lot more in taxes overall. So certainly this can also result in these additional taxes being pushed down to us as consumers, right? Because corporations are not just simply going to take lower profits moving forward. They're going to pass these costs on to their customers, which are usually you and me. All right. So is this really a tax increase just on corporations, or is this an overall tax increase on everyone? Because this isn't going to come out of corporate pockets, I can assure you. This one's really interesting. This creates a minimum tax on corporations with book profits of $100 million or more. Book profits, not tax profits. Two different things. The minimum tax is structured as an alternative minimum tax. Corporations will pay the greater of the regular corporate income tax or the 15% minimum tax while still allowing for net operating loss and foreign tax credits. That got a little bit technical, but we're going to dissect it, take it apart, make it real simple. Corporations generally have two sets of books. I know that sounds really shady and illegal, but it's really not. The first set are the book financial statements, which have their own rules. They're usually prepared under GAAP or generally accepted accounting principles. So you have the books, and then you have the financials for tax purposes, right? So they may differ because there are some things that are, let's say, tax exempt. So income can be tax exempt. So it's reflected on the books, but not reflected on the tax return, or essentially not subject to tax. It's an adjustment to go from book to tax. Similarly, you may have some tax credits or net operating loss carry forwards that are applicable on the tax side, but not applicable on the books. And there are all sorts of adjustments that corporations need to make between their book income and their tax income. And in some cases, they can have significant income on the books, but zero income on the taxes. Now, how is that possible? You guys that have been watching my channel, how can that be possible that you have income on the books and not on the taxes? I'll give you a few seconds while I take a swig of my majestic beverage, being tea. That's my favorite. All right. So what's going to happen is that if a corporation has income on the books but no income on the taxes, what they could have done is taken bonus depreciation or Section 179 or other accelerated depreciation deduction, which changes their income on the book side versus the tax side. What this alternative minimum tax is going to basically mean is that corporations are not going to be able to take advantage of those book tax differences, in that if they have book profits but no tax profits, the book profits may result in tax in and of themselves, even though their taxable income for tax purposes may be zero. That's kind of hitting below the belt, I feel like, right? Because if you're a corporation, you have all these tax write-offs that you can take on the tax side that may not be applicable on the book side. Now you're having to consider your book income and pay taxes on that. It kind of negates the benefit of putting together those deductions in the first place, I think. That came out of left field a little bit. Very interesting in that they're looking at the book and not the tax income amounts for purposes of this particular tax. So they're looking for more alignment between the two so that there isn't a huge disparity in terms of, hey, this corporation had $150 million in book profits and zero for tax purposes. They're still going to get hit with the tax. They're not going to be able to skirt by with so much in book profits and very little tax or no tax that they're paying. Interesting approach. Interesting. But again, I think this is still going to trickle down to us as consumers and be reflected in terms of higher costs. I don't see another way for that to work. Now, some of these other provisions are pretty technical and they are related to the corporate side, and I'm not going to get into too much detail here. We're talking about the GILTI over here. This is the Global Intangible Low Tax Income. Most of my clients don't deal with that. Vast majority of people don't come in contact with that for the most part. Let me just see if there are other items here that may be applicable. There are other taxes being proposed on corporations that offshore manufacturing and service jobs to foreign nations. The push is to bring more manufacturing and production to the United States. So I could see that some of these provisions are aimed in that regard. And ultimately, I think that sums up the major points that are going to really move the needle in terms of tax liability on the corporate side and the individual side. I have to say, as someone who does taxes for a good amount of clients that make above $400,000, this is going to be painful. And I understand the lack of sympathy that may be present from those who are not at those levels in terms of income. But I can tell you that even paying 39 or 37% of your income in taxes is just not attractive and does become a burden, because essentially once you factor in the state taxes and all this other stuff, about half of the amount that you're earning is going to taxes. On the other hand, if you have mostly investment income, it used to be the case that you can simply enjoy qualified dividend rates and also long-term capital gains rates. But now those lines are going to be blurred. So I wonder what planning opportunities and implications may arise from all of these differences, because these are tectonic shifts really in long-established tax policies that everyone has gotten pretty used to, pretty comfortable with. And it'll be interesting that if these provisions are actually put in place, what movement we're going to see in terms of assets, in terms of income, and restructuring to try to adjust to the new tax landscape. And with that said, hopefully this was helpful. If you like this video, feel free to hit that like button, subscribe to the channel, leave a comment. If you leave an interesting question in the comments, I may just answer it in a video just like this one. And with that said, hopefully this was helpful. Thanks for watching.